Good morning and welcome to this Progeny LinkedIn Live event. This morning we are demystifying evidence-based ESG and what financial planners need to know. So historically the challenge has been, how do you deliver ESG using an evidence-based approach? And how do we get that messaging right with our clients? So this session is really here to help you understand the current evidence-based market better. How can you talk to your clients? And what are we doing at Progeny in this space? So I'd like to welcome Craig Melling. Craig is Head of Investment at Progeny, and he's going to help me through this live event. We've also got guest speakers from Dimensional and also Schroders. Just as a start, we have got a Q&A at the end, so please submit your questions in the comment section, and at the end of the session, we'll go through the Q&A on LinkedIn. Okay, so just moving on then, just bring onto screen here a portfolio. And we're going to start with a live poll. This is a sample portfolio, and what we want to know is, do you think this portfolio is ESG, and particularly evidence-based ESG? So Craig, just bring you in. What's your thoughts on that portfolio without giving the game away?
Well, I'm actually really interested to see the response to this poll, because for a long time, there's been a lot of compromise, certainly with ESG and evidence-based investing. And when we often hear terms like step in the right direction. And for us, when we're talking to advisors and we're talking to clients, this is seen to be quite opaque. But the good news is the landscape has changed, it's evolved, and we're going to be talking about some of the exciting things that are going on in space in the seminar.
Okay, fantastic. So we'll come back to that live poll later. So have a look at that and let us know your thoughts. So let's just move on then to, firstly, an ESG statement. Look, we're not going to tell you today what is ESG. You know it's environmental, you know it's social, you know it's corporate governance. It's probably important that we tell you at Progeny what we think it means, and we believe it goes beyond those financial metrics when you value a business. It's the non-financial metrics that are important. And we believe it should be part of your DNA as a financial services business, and going right beyond that, right into the wider economy and businesses, that ESG should be at the centre. So that's the big statement. So let's just move on to this. So why is ESG investing growing is a question here, and I'm going to start on that, Craig. Look, we're a regulated business. We've got regulated businesses on in the audience, and regulations has driven the growth in ESG investment. And as part of your onboarding process, your advice process, you've got to take into consideration your client's ESG preferences. And also good governance, really important, that we believe in the long term you get better investment outcomes by having good corporate governance. And just look at Larry Fink at BlackRock. He wrote out to the CEOs of their investments saying, look, tell us about your ESG credentials. We want to know, we want to invest in the right businesses. Okay, Craig, over to you. What's your thoughts in terms of why we're seeing growth in ESG?
Well, I think first and foremost, ESG and the need for it isn't new. I think the means and the ways we hear and talk about ESG is evolving. And I think that's largely down to technology. And technology's got a big part to play in things like renewable energy sources becoming more reliable, more accessible, more usable, but also the way we consume intangible and tangible goods. News flow is almost instantaneous, and with powerful things such as social media, we hear about ESG, and there's almost activists on ESG on social media. So the way we hear and talk about ESG is all consuming, and that's not even mentioning kind of high profile celebrities. You know, we've seen the war on plastic, primetime BBC television, and probably the most powerful for me was Sir David Attenborough's My Witness statement. And if anyone who hasn't seen that on Netflix, please go to it and have a watch, because it's very, very interesting how someone so influential has captured in his wonderful life so many fantastic images, but the sad part is he's almost captured the deterioration of the planet. And in the documentary, it talks about that, but what the future looks like. So it's very, very powerful. And it's things like this, which is, it's almost bringing ESG more prominent to the masses and in our day-to-day lives now. But sadly, I suppose, Ian, what comes with that is lots of noise. And it's very hard sometimes to cut through that noise.
Absolutely. And I think just going back to Sir David, he really brought it into your front room, didn't he? ESG and some of the things, the issues out there. So as you say, really, really powerful stuff. Coming back to the noise then, I think that brings us nicely onto the next image. If this doesn't tell us why we need a clear message and a defined message, I don't know what will. These are all words that we associate with ESG. So Craig, what's your take on this image?
It's really jargon bingo, isn't it? And I think our industry is full of jargon as it is, but with the emergence of ESG, there are lots and lots of prominent words like this. And really, there is a lack of standard and a lack of clarity, which makes it quite difficult for investment managers like ourselves, for planners, and even more so for clients. There can be inconsistencies on ESG ratings, etc. So lots and lots of noise, and these words really depict that.
So let's just pick up on one of those words, ethical. I've been in financial markets a long time. It's been used a lot, ethical. What's your view on that word, Craig?
For me, it's probably the most dangerous word on that list there.
Why?
Because it means something completely different. And you're right, Ian, for the last 10 or 20 years, probably the word ethical has been used a lot in this space. But with the emergence of ESG, it's very, very different what ESG investing is and ethical investing. And for me, that's why it is probably the most dangerous word on there. But these words are getting used a lot more in our day-to-day lives. And I'll pick one out, and you won't thank me for saying this, but sustainability is the one that I see in advertising, in marketing. It is becoming more prominent, and these words, because of their connotations, have been used more and more in our daily lives, and they're subliminally being put towards us. So it really is hard to cut through that noise and understand kind of what these words actually mean.
I think what you're saying, Craig, is the challenge is if, as financial planners, investment professionals, we can't understand the words and get the message right, how can we expect our clients to get it?
100%. It's very, very difficult. And for us, we're seeing things such as greenwashing. We're seeing things where funds are changing names. Their investment philosophies may be changing. So it's very, very difficult. And we spend a lot of time looking at funds, and the devil is sometimes in the detail.
Okay, so let's move on to the next image. So Craig, what are the challenges in implementing evidence-based ESG?
The biggest challenge historically probably has been the lack of product or lack of funds available to actually marry the two solutions together. But as evidence-based investing is evolving, factor-based investing is evolving, we can based. And when you think about it, Ian, evidence-based investing is based on rules. And if you a set of rules around S and G, then why shouldn't these work very, very well together? And for me, that's what's really exciting.
Okay, so I think what I'm picking up there is that the growth of factor-based is really important in this journey. And obviously rules are really important, as we all know, within financial services. So let's start talking now about defensive and growth assets. And let's start with defensive assets, fixed interest. Because I think, Craig, that's where one challenge has been, hasn't it, in terms of execute evidence-based ESG in fixed interest. So I'd like to bring on screen now Kip Cummins from Dimensional. Morning, Kip. Welcome to the Progeny LinkedIn Live event.
Yeah, thanks, Ian. Thanks, Craig, for having me today.
So Kip is a senior portfolio manager at Dimensional, and we're going to ask a few questions about your process and your view in that space. So first question, Kip, historically, it's been a challenge to marry evidence-based investing and ESG. How have Dimensional approached this?
Yeah, I think, as an evidence-based or systematic investment manager, I think it's first important to really understand our core beliefs, and then to also consider how those core beliefs can translate to the ESG space as well. And I think first and foremost, I'd be remiss to say that at our core, we believe that market prices do a very good job of incorporating information, and that includes information about ESG and specifically ESG risks. in individual companies, individual bonds that we're buying. Another thing is to understand that market prices inform us about different premiums or factors in the universe that we're pursuing. And this translates to ESG as well. So we really rely on our research department to inform us and to let us know if there are premiums associated with ESG. So it's really in our DNA, and it's important that we integrate these ESG considerations both from a research standpoint as well as a data standpoint, and then finally in the implementation of portfolios. Now, ESG really comes down to considering a universe of individual securities or bonds in my case, and screening that universe. And that is something that we've been doing at Dimensional since the 1980s, and really started focusing on social and sustainability considerations in the mid-2000s. A lot has changed, I think, over the last 10 years. In the last couple of years, I think specifically in fixed income, the quality of the data has been improving such that you can really marry an ESG approach within the fixed income space to try and not only sacrifice or to not sacrifice the pursuit of higher expected returns through an evidence-based framework, but also doing so while considering the very important ESG considerations that clients have day in and day out.
Okay, thanks, Kip. So let's just lead on from that. With the parameters you've just gone through, how is this actually implemented day to day in your portfolio? And is it much different to the non-ESG equivalent?
Yeah. So I think when you're approaching ESG within an evidence-based framework, I think it's first crucial to understand what the goals of the portfolio are. You can't deliver everything at once, and so you need to be quite targeted about what you're trying to pursue within an evidence-based ESG framework. And so for us, that starts with not only talking to leading academics and scientists within the space, but also talking to our clients to understand what's important. Now, the next thing from there is to really, once you understand your goals, is to look at the data, the availability of the data. Is it measurable? Is it reliable? And can you transparently integrate that data into an evidence-based approach to pursuing higher expected returns? Now, within the framework of our ESG focus strategies versus the rest of our lineup, the one thing that we need to be absolutely certain that we're doing is that we're not abandoning our core philosophical beliefs, that we're able to pursue higher expected returns and achieve similar returns in both an ESG focused and a non-ESG focused. So the approach to managing the portfolios through the pursuit of higher expected returns using forward rates as our sorting variable is no different within the ESG focused versus the non-ESG focused. The next is to really understand what's important. And I think that's where, the conversations with you at Progeny, with leading scientists to understand, what is really driving climate change. We know that is greenhouse gas emissions. And so our strategies are keenly pointed towards trying to reduce carbon emissions to, the greenhouse gas emissions in the environment. Now, there's a number of other considerations that are important to clients, like land use, biodiversity, child labor, tobacco, to name a few. And you're able to obtain quality data, not rely on the actual scoring done by MSCI, for example, but actually take the raw data from these data vendors. And as we're experts in data, really calculate our own scores for all of the companies in the universe, and then screen out those that are bad offenders, but then also try and reward those companies that are doing a better job. So that might mean overweighting those companies that have more sustainable activities, and maybe underweighting or outright excluding those that have less sustainable activities.
Okay, thanks, Kip. Now, the next question, Craig, I think this is the one I want to really hear the answer to is, Kip, how do you see this space evolving over time?
Yeah, so I think that there's a number of things that will influence the evolution, and and it has evolved quite quickly, particularly over the last couple of years. I think as a systematic or evidence-based investor, one thing that we're heavily reliant on is the data. And so I think that as the data quality out there, the data that's being generated by the companies themselves, as the quality of that data continues to increase, and consumers of that data, we will be able to better target specific outcomes. At the end of the day, we want to be very transparent about what it is that we're trying to do in the portfolio, not only include increased expected returns, but also to reduce carbon emissions or exclude bad offending companies. And that starts with the data. I would say, a second thing is really going to be around the regulation. And specifically tied to data, you look at, pieces of regulation like, or bodies like the TCFD, the Task Force for Climate, related disclosures. And these are things that we support and will be absolutely crucial into the evolution of the space. I think the broader regulatory framework as well, like SFDR, in really holding investment managers like Dimensional to account to make sure that we're disclosing what it is that's important to our end clients. And really the final thing I think is, for those listening to this call and the end clients that are, that buy the funds, and that's understanding what clients are actually wanting. ESG means something different to different people. And so you need to be very, very clear about what it is that you're doing, and you need to listen to your clients to make sure that you understand what's important to them.
Kip, thank you. Two things there. I'm glad you really picked up on the regulation. That was something I talked about a bit earlier on in the session. And again, the clear message, again, something we're going to talk about a lot today. So Kip, thank you ever so much for joining us this morning. Thanks for your answers and your time, as always. That's Kip Cummins from Dimensional. So just a reminder, we have got a live Q&A, so please put your questions in, anything that you see today, any questions on what Kip's just spoken about, please put questions in and we will answer them at the end of the session. Okay, so moving on. Craig, back to you. So how does Progeny implement ESG?
Well, first and foremost, for all our portfolios, we want them to be transparent. And I think when you're looking to build and integrate ESG, that is the key. And for us, when we set out on kind of our journey, it was about creating a portfolio which, as Kip says, had a clear and concise message, so that not only does the client know what they will have, they'll know what they won't have. And with this, we spent a lot of time with leading index providers and looking at the exclusions we might want to do. And I'll come on to that in a second, because it's worth spending a little bit extra time on that, because it's very, very important. It helps set you off on the right path. But for us, with any evidence-based or systematic solution, it's about starting with that parent index and then understanding the tilts you're going to make, whether it's small cap value or ESG, what those decisions and those tilts, does it kind of impacts they have on the client journey or the characteristics of the portfolio. And from there, we have our investable universe. And what we really wanted to do here at Progeny is promote those ESG leaders, so that we were buying companies with the highest ESG scores. And lastly, we were almost wanting to create a portfolio which had, because carbon emissions were very important to us, that had reduced carbon footprint. And I'll be honest, Ian, we thought it was going to be a challenge. We set ourselves the goals at 50% less carbon. And myself and the team, we thought it'd be very challenging to do. But actually, by promoting those ESG leaders and actually coming back to something you said earlier, promoting those companies with good corporate governance, the carbon emissions actually became a bit of a byproduct of the portfolio and was much easier for us to integrate than we first thought. But it was about having that clear, concise message. That was the main aim for us when we were setting off on this journey.
Yeah, I think I said earlier on in the session, good corporate governance, we believe, leads to better long-term investment outcomes. So thank you for underlining that point, Craig. So let's move on then. So we've just now got a graphic on screen, which we're going to talk through with Craig. I'm going to pose a couple of questions to you, Craig, on this. So firstly, how has Progeny been consistent in its approach? And what are Progeny's broad ESG messages? Let's just talk me through this graphic and what's been going on there. So
the approach is key, really, because I say it sets you off on the right foot. So for us, we spent a lot of time with index providers, with MSCI, one of the leading index providers worldwide. And as you can see, they've got a number of ESG indexes. And with each index, there is a different set of criteria and exclusions. So for us, we spent a lot of time looking at historical data to try and understand the impact of these exclusions, what it would mean for the characteristics of the portfolio, and ultimately the client's journey. and which one of these would give us that clear and concise message. So we actually, if you work through the chart on screen, we actually ended up aligning ourselves. And I often say sleeve here, but the index we aligned ourselves to was SRI, and it just gave us that clear, concise message. So when we were talking to fund houses, when we were talking to large institutions, you've got a clear idea of what you want to see from certain funds or the products you are looking to use.
Okay. So let me just come in here. So it feels like, I don't like using the word exclusions, let's call it filtering to get to that top corner. Just talk me through some of the things that you've looked at in terms of is it ESG scoring tools? Is it not investing in certain areas? Is there a percentage weight that you put into certain capitalization revenue stock? How have you pulled that together?
Well, all of the above is the short answer.
Fantastic.
For us, we wanted to create a global portfolio which married evidence-based investing and ESG at the core of what it did. So for us, we wanted to weight towards the highest ESG scorers. That was almost a paramount. But we also wanted to exclude certain sectors. So there are, a total exclusion on tobacco producers, controversial weapons, and nuclear weapons. Then we have a 5% revenue cap on other controversial sectors like alcohol and gambling, for example. But really, it was, as I say, setting out on that journey to be clear, concise, have a defined set of rules for how we pick funds and how we communicate to our clients so they understand what they will and will not have. And once we had those rules, then as I said, we had that carbon intensity over the top as well. So not only do we have those exclusions we've just talked about and inclusions of ESG leaders, but we've also got that reduced carbon footprint. And as I said, by having these rules, it really does, and this is the key takeaway for me on this whole journey. By having these rules, it really does help you filter out that noise we've been talking about, that jargon bingo we saw earlier. Because if you're talking to fund houses, to intermediaries, to clients, you know exactly what your portfolio will look like at any one given part of time. A clear and concise message.
Feels like today we're talking a lot about rules, and that's driving a lot of what's happening in this space.
Very, very much so. And having that filtering process really helps you kind of marry an evidence-based solution and ESG together.
Okay, so let's keep on with the filtering then. Let's move to the growth assets. And I think it's time to bring on screen Eamon Shanks from Schroeder, who's going to talk about the growth assets. Morning, Eamon. Welcome to the
morning, both.
The Progeny live event this morning. Couple of questions for you. So first one is, what exclusions do you have in your process, and why do you have those exclusions in place?
Sure. So I suppose I'll probably actually start with the why before the which ones, to be honest. And I think if you're marketing yourself as a sustainable fund and you're true to badge in terms of what you do, then there are certain industries that you really cannot and should not invest in. And so when we went about sort of applying and thinking about the exclusions that we do for our sort of global ESG fund, we thought, what are those industries where there's the greatest weight of sort of asset owner objection towards? And what are those industries that actually also face the greatest structural challenges to their business models and their operations, given their either societal or environmental cost? And from that, we created quite a broad raft of exclusions, and given that we're a quantitative team, we're able to consume a lot of MSCI-based revenue or reserve data. And so in terms of the exclusions that we'll apply, on the environmental side, it's things like thermal coal, nuclear power, unconventional oil and gas, palm oil. So those really environmentally impactful activities and operations. I mean, thermal coal 4 times dirtier than any other fossil fuel, unconventional oil and gas, whether it be shale oil or tar sands, really creating huge issues in the sort of areas in which they're operating, whether it be water stress or environmental impact, as well as palm oil, given the sort of the deforestation across the Amazon, Indonesia, those sort of areas, and the real effect on the ecosystems there. And on the social side, as you already mentioned, things like weapons, whether it be civilian, military, controversial, tobacco, alcohol, gambling, etc. I mean, these are areas where if a client had invested in a ESG or sustainable fund, and you looked at its holdings and you saw it was holding a coal fund or sorry, a coal stock or a tobacco stock, you'd have to ask the question, just how sustainable is this fund? And I suppose I've got actually a question for you guys. You should be, as investors yourself and dealing with your clients, what's been the sort of the key maybe concern or issue that's been raised in terms of excluding anything from the opportunity set?
Okay, Eamon, thanks for the question. Craig, I'm going to turn to you. What's your thoughts on that?
Yeah, no, for us, the big hard exclusions and where we've discussed with clients is very much the sectors you've just said, Eamon. You know, tobacco is a big one, probably the most prominent. And then when you come to things like thermal coal and oil sands, and I think these are the ones that are in the forefront of clients' minds now, because you know, there's health implications towards certain sectors, but also in those high-profile documentaries that we were talking about at the beginning, you know, they are featured quite prominently in there. And palm oil is one which is growing and being talked to us, you know, a lot more each time we speak to a client.
Yeah, I think I suppose there are two aspects, especially with regards to exclusions, and one of them is, you know, doing, let's say, the right thing morally, ethically, from an ideological standpoint. And the second thing would be to, you know, always remember that we do have a fiduciary duty towards our investors, and these sort of things have always got to be done in an investment-led way. So another thing that we did in Schroders in the QP team specifically was to say, right, if we are excluding these certain areas, if we're sort of reducing our opportunity set, just for reference, is around 10% of the AC world, those areas that we do exclude, what is the impact going to be on returns, and is it something that we can do as, you know, as responsible asset owners from the client side as well as from the human side? And you know, the analysis that we've done actually shows that if you look at those areas that we exclude on desk for our ESG mandates over 5, 10, 15 years, actually excluding those parts of the index have had a negligible effect on returns. And if you then start to include fossil fuels in the calculation, actually alpha is slightly higher. And so what it does show is that even though, you know, you're reducing the opportunity set and you're removing these sin industries or worse industries from an ESG standpoint, the effect doesn't have to be sort of detrimental to your performance generation.
Hey, I'll just come in there. I think we was almost going to the next set of questions here. Is what factors do you score companies on, and how do you integrate valuation and profitability into that process?
Yeah, of course. So if we start with more the fundamental side, or as you say, sort of valuation, profitability, essentially QEP are, for anyone who sort of doesn't know us a bit better than you chaps, are sort of value quality investors. And so on the value side, we'd be looking at things like earnings, including things sort of like earnings to price, recurrent earnings from operations, an asset-based view, which we would actually implement not in a sort of a broad-based way, but specifically for those companies where assets still matter, because we're aware, obviously, the rise of intangibles and how much does asset matter in terms of valuation. So for real estate, material companies, banks, there will be an asset-based measure in there, looking at things obviously simplistic, things like book to price and that kind of thing. Having a view on cash flows, so cash flow from operations, a recurring free cash flow for equity, that sort of thing, as well as a quality adjusted yield measure, which essentially takes a view on how sustainable, the other meaning of sustainable, is the dividend a company pays. So what's its sort of level of indebtedness? What sort of dividend has it been paying? Is it funding that dividend through debt? Is that going to be sort of at risk from a cut? And so we're saying, how likely is it to be going on in the future and to grow in the future? And that's a quality adjusted yield measure. On the quality side, we split it again according to a few different pillars. One of them being profitability, no explanation really needed there. Another one being stability, and that's chiefly the sort of stability of margins as well as stock volatility. Financial strength, which again is looking at the sort of level of indebtedness, so debt to asset, interest margins, leverage ratios, that sort of thing, as well as an input for sales growth. So looking at what the historic sales growth has been, what's the sort of analyst revisions going back, and what's the sort of growth expected in the future. And so that covers the sort of the fundamental side. And the way that we integrate ESG more broadly on desk would be without sacrificing that fundamental equation. Given, you know, we've got sort of 10,000 plus stocks in our investment universe, we would say, all else being equal, let's invest more in a good ESG stock, and let's invest less in a poor ESG stock. And there's no reason that those things can't go hand in hand. But on the ESG side, sort of more specifically, we actually think of it more in terms of sort of GES. We anchor our ESG model on governance, given, well, a couple of different things being, firstly, in terms of backtesting alpha generation or potential returns, it's proven to be actually the pillar where you can sort of garner the most outperformance. Secondly, it's sort of universally applicable. So where environmental or social issues might be sort of paramount for some companies and really not really important for another one. So why would you reward let's say a tech company having low emissions versus an energy company? It sort of doesn't make sense. Governance considerations can be sort of universally applied across the piece. And within governance, we'll mix sort of fundamental measures with more, let's say, new ESG based measures. So dividend policy is a signal for good corporate governance, as well as things like accounting risk to shareholders, business oversight, and that sort of thing. And we'll use that as the anchor variable to base the rest of our model on. And then we'll use the environmental side and the social to scale that score up and down. And from the environmental piece, we'll look at things like carbon emissions, so total emissions, carbon intensity, potential emissions moving forward. We'll have a view of stranded asset risk. We'll incorporate carbon reduction strategy. And what's really important here is we're not just going to take a company at their word. We're not going to say company X has committed to reduce its carbon emissions by 20% year on year. We're going to say, right, what is its carbon emissions? What have they said they're going to cut it by? And what's been the efficacy of them meeting those targets? And if they're saying they're going to reduce it by X and they're not meeting it, we'll introduce a penalty into that model to sort of reflect the fact that they are not reducing it as they say. So it's not as simple to just take disclosure as gospel, if you will. And then having a view on environmental impact, that'd be things like nitrous oxide, sulfur oxide, land use, water stress, and then environmental opportunities. So things like green building initiatives, as well as sort of renewable energies. And then finally, on the social side, it'd be things like business involvement, safety, employee welfare, supply chain practices, and data privacy, as well as having a sort of a controversy input within that model also.
Eamon, thank you. I think what Eamon's saying, there's a lot of factors going behind the scenes on the growth asset side. Eamon, thank you ever so much for joining us this morning. Great to hear from you, and hopefully we'll see you soon. Just a reminder, everybody, please put your questions through LinkedIn, anything that Eamon's just talked about, anything we're talking about, and we'll come back to it on the Q&A later. Okay, so moving on from growth assets, I just want to spend a moment talking about our philosophy in terms of investments. And I would expect this is something most people in the audience will understand and possibly have in terms of their beliefs, that we believe capitalism creates wealth. We do believe markets work reasonably well. We know risk and return, Craig, are definitely related, and diversification is a risk management tool. And then how do we apply that? What are the 5 practical imperatives? Well, we've spoken about that today already, haven't we? You've got to get the growth and defensive asset mix right. So get that asset mix right. I would expect everyone to diversify broadly. Do not put all your eggs in one basket. We know that from an investment standpoint. Craig, managing financial costs, do you want to come in there and just give your thoughts on why that's so important?
Any cost is very, very important, and you've got to know kind of what you are paying for. And for me, when in any investment I think about, it's almost balancing that risk, reward, and cost, because we know the issues and the eroding of capital costs can bring in. So it's really focusing on cost to understand what it actually is you're getting for, what bang do you get for your buck?
Absolutely. Thank you, Craig. I think the next one's a really important point, and we saw it with the stock market last year. A lot of noise. You need to leave emotion at the door. It would be costly emotionally if you get dragged into the market noise. And finally, rebalance the portfolio, Craig, again, manage back to your risk. And that's something we do here at Progeny. So just moving on, just a quick word about our Bravo ESG portfolios, Craig. And I just want to start there by one of the benefits of Bravo from our point of view is it's discretionary fund managed. So what we can do is, because you've spoken a lot today about evolution, about factor investing, the space is changing. we have the ability to be close to what's happening, and we can make those changes efficiently and effectively. What's your thoughts on that?
Yeah, you can probably tell I'm very excited about what's going on in this space. We're talking to a heck of a lot of people about funds. The team we're speaking to a number of fund houses just last week about funds that they've had running in different parts of the world, which are integrating ESG and evidence-based philosophies. So for us, we're very excited. It's evolving very quickly, and I'm probably understating that. It is growing very, very quickly. And for us, the portfolio we've created, so Bravo ESG, we probably couldn't have done it 12 to 18 months ago. Whereas now, if I think forward to 12, 18 months, the portfolio may look slightly different. It may have changed because of that evolution and that emergence of new funds and new products.
But what about the benefits of that quarter rebalance? Again, that's something we can add into the Bravo.
It is, and I'm thinking back to kind of the emotional time of last year, and what we were doing when the markets were moving around aggressively, and it wasn't just the quarterly rebalance. So knowing our clients were in risk by rebalancing quarterly, it's the drift management. And when you're seeing violent swings in the market, we were monitoring portfolios every day and their defense and their growth assets to make sure clients always remained in risk. And if it didn't happen, but if it had have done and clients had have moved out of risk, we could have automatically rebalanced. So everyone's got that comfort that their clients and the clients got comfort that they're in the risk category they should be in. So that rebalance is paramount. Okay,
that's a great point about the drift management, Craig. Thank you for that. So let's just move on now. We're going to bring an image on screen, which is a lot of detail on there. We're not going to go through every point, but this is just sort of, I think it pulls together everything we've spoken about today, really, in terms of Progeny, what we've been doing with our Bravo portfolio. So Craig, do you want to just talk us through a couple of key points?
Yeah, this is what I'm very proud of, Ian. This is that clear and concise message. So when we're talking to planners and clients alike, this graphic is really what they will and will not have. So for us, as you can see, there's the hard exclusions at the top, and then the 5% revenue levels on some of the more controversial sectors. But no, very proud of this. And this was the combination of a lot of hard work, but having that focus of having that clear, concise message, that transparency right at the heart of what we did.
Okay, that's great. Again, the messaging all important in today's session, and I think that's very clear on screen right now. So I think we're going to move to the poll results. So let's see what you made of the portfolio we put on the screen at the start of the session. And okay, 43% of you thought it was evidence-based ESG. 57% thought no. Craig, what's your thoughts on the result?
So it's close. 57% I would agree with. I don't think is ESG. I probably would class it as a step in the right direction, because it almost felt like the investment philosophy was first and then ESG. And what we're seeing now in the emergence of products and the things we've talked about and the speakers have talked about today is you can actually bring evidence-based investing and ESG together at the heart of a solution. So for me, I don't think it was ESG, but I think the exciting thing is now we can do ESG with evidence-based investing.
Okay, great. Thank you for that. Thank you for everybody that put their answer in on that portfolio. So moving on now, we're going to show a short video, just an explainer about our Bravo solution. At the end of that, we're also going to bring in Rob Harrison. He's one of our investment managers, help build a solution to take part in the Q&A to finish the session.
Environmental, social and governance, or ESG investing, aims to encourage positive social and environmental change through your investment choices. One of the myths about ESG investing is that you'll have to sacrifice potential returns for your principles. Progeny's Bravo ESG portfolio range is a managed investment service with ESG at the core of its process, but it does not compromise on performance. We target the highest scoring ESG companies and use a strict process for deciding which firms will and will not be included. A key advantage is that a discretionary fund manager will oversee and make decisions on the portfolio on your behalf and can respond quickly to new products as the ESG market continues to develop, giving you peace of mind that your portfolio is on track to meet your financial goal. Our investment managers have been building portfolios and models together for over a decade so you can be sure that your investments are being carefully looked after by an experienced team. The Bravo ESG range allows you to stay true to your principles while providing the portfolios to match your investment goals.
Okay, welcome back. So you're going to welcome Rob Harrison on screen shortly to help in the Q&A session. So let's see what questions have come in. We did have some questions also sent in by email, so we've got a few questions to get through. So let's start with this one. How much greenwashing have you seen in this space, and are there any of your holdings? Are any of your holding normal funds which have been greenwashed? Craig, shall I start with you on that one?
So I'll answer the second part first. There aren't any of our funds which have been greenwashed, but we have seen a lot of greenwashing in this space. There's been a lot of change in this space. You know, there a lot of evolution, and you know, with that comes almost confusion. So it's been tough to cut through the noise probably in the last 12 to 18 months in all aspects of ESG, as it has become more prominent and fund managers have made it more prominent. But that's why, you know, if you've got that kind of that clear filtering process, it will make the job a lot easier.
Okay, thank you, Craig. Good question here. Is the investment selection process much more time and expensive for an ESG portfolio in comparison to a non-ESG portfolio? And if so, could it reduce long-term returns? Rob, I'm going to bring you in on that one. What's your thoughts on that question?
Thanks, Ian. That's a great question. From our side of the fence of building portfolios, there's a lot of time that goes into looking at the new products in the ESG range. From our side, we have the same charging structure for our ESG and non-ESG solutions. In the fund management world and the products we're buying, they are slightly more expensive. What we're finding is there is more that goes into these products, but it's actually due to the scale. So as they get larger in size, the cost comes down. So I would say give it 3-4 years, might even be sooner, but when they get to a similar scale as the other funds, I expect the prices to be about the same. A rule of thumb at the moment, I would say, is about 10 to 15 basis points more on an ESG systematic solution.
Okay, thank you, Rob, and great question. Thank you for that question. So Craig, back to you on this one. How do you expect the systematic ESG area to grow over time?
Exponentially, I think is the word I would use. I think, you know, factor-based investing is growing, and I think I alluded to that earlier on in the session, but it is growing. We're seeing more and more demand as well, and I think that's key here. It's client pressure, advisor pressure, investment manager pressure, because we want to invest our monies like this. And my view actually is in the future it'll kind of be, why aren't you doing ESG, rather than currently why are you doing ESG? So I think it will grow. It's an area which is going to become more prominent and probably become the norm.
Okay, thank you, Craig. Craig, I'm going to leave you alone for a second. Rob, I'm going to bring you back in on this one. Are the Bravo portfolios suitable for all clients who have ESG beliefs? Good question.
That's a great question. We would say they're probably suitable for about 95% of clients. The key message to speak to your client about is what are their ESG beliefs and what are they expecting. So of our portfolios, as Ian and Craig have gone over, we have strict criteria that says about 5% in certain segments, not having thermal coal or tobacco. So for clients that meet that criteria, it is suitable. We have come across a few clients which have very specific needs. People that are we've had vegan portfolio requests. We've had lots of different beliefs. If you've got religious beliefs on alcohol and you want zero alcohol exposure, it's just key to make sure you find out what your clients are after, and then we'll be able to advise to say it does fit in with our criteria, or it would need to be a bespoke mandate because it's a different criteria. Okay,
thank you, Rob, for that. Craig, I'll bring you back in on this one. Do you think we'll see a future where ESG and this is a great question, is the only form of investing? It's a good question. That.
Yeah, it leads on from what I've just said, and I believe, you know, ultimately it probably will. I think it will grow in its prominence, and I can't say if it will be the definitive and the only way of investing, but I think it will be the prominent way of investing. I just think the way we consume, the way we all talk about it, and ESG has probably impacted everybody in this session some way, and we've probably thought about it, you know, certainly when we've been locked in our houses for the last 14 months or so. But it's something, it's about a way of life, and I think everybody is feeling responsible now, and that's in day-to-day life and investing. So I think it'll become more prominent.
Okay, thank you, Craig. Rob, bring one question for you now. Do impact investors look at companies through ESG, public and private markets, in their investment thesis? That's a really good question.
Yeah, so impact is sort of one of the key words at the moment. I think Craig had a great slide earlier on with all the jargon. So impact investors are traditionally looking to invest in companies that have a real definable impact in the world. So something like a Xylem that does water purification, that really does help improve people's lives. For typical impact investors, they sort of more to the right-hand side of the scale. So they'll have the traditional ESG criteria that we have, and they'll go the next stage and really narrow down the universe. So as Eamon said earlier, for Schroders, it probably excludes around 10% of the universe, and we find this when we look at different products. For impact investing, you're probably only including about 5 to 10% of the universe. So it's a very much more a niche way of investing, and it is arguably higher risk because your universe is much smaller.
Okay, Rob, do you want to stay on? Because I've got another great question for you. Where does the Bravo portfolio range sit on the risk scale? For example, could a client with a cautious risk profile but strong ethical preference still hold it? Would it be too risky? Again, another great question.
That is a great question. So our Bravo range goes from 0% equity up to 100% equity, and is in increments of 10. So it's there to fit everyone along the risk scale. In the past, there was probably belief that if you invest in ESG, you are taking more risk. That really isn't the case now. There is slightly less diversification because you are missing out around 10% of the universe. But this is very marginal. And when we've done our research and we've looked at the volatility of the portfolios and the amount of risk people are getting, in most cases, it's actually slightly less, because the parts of the industry you're generally excluding or are underweight are typically the higher volatility part of the index. So for an ESG investor, you can fit cautious investors into this space now.
Rob, thank you for that good answer and a great question there. Craig, I'm going to come back to you. Do you expect to see any changes to the portfolio over time? And if so, how's that going to work through? How are we going to get to that point?
So certainly, I do think there will be changes, and I think it comes back to a point I don't want to labour, that there is an evolution in this space. So we are, we won't make changes for change's sake. We spend a lot of time looking at our investment decisions and what impact that will have kind of on portfolios, on clients, and on the characteristics. But if we're given the emergence of new portfolios, we can hone that ESG and evidence-based investing together, and we can really focus on the rules-based approach we want to implement. The portfolio will change, and the beauty of discretion, Ian, is we can make those changes for clients if we feel it's best for them to do.
Great, thank you, Craig, for that. So, Rob, another one for you. Are the Bravo portfolio suitable for clients that don't have ESG beliefs? Another good question.
No, that's great, and this is something that's actually come up a lot since we've launched the Bravo range. We would say if you've got to have the conversation with clients about ESG is important, and to find out their beliefs first. If a client's got no ESG beliefs or preference, which we have seen, and they just want a normal portfolio, then we'd recommend just going to a normal systematic solution, which is our Tempo range, on the same risk levels of Bravo. It is designed for clients that have ESG beliefs or are wanting to have a portfolio where they feel like they are having a more positive impact into the world by excluding some of these industries.
Okay, Rob, thank you for that. And I've got one more for you. Are there any positive impact factor-based funds available, and are they in the portfolio?
So at this moment in time, there isn't any positive impact factor-based funds. The real issue with positive impact in factor-based investing is when you look at the universe, as factor-based investing generally does, you start with an index. With ESG, you put some filters on, and you still have a reasonable index to work with. Because impact is so niche and you are targeting very specific companies, it's very hard to then have the valuation beliefs within this space. We don't have any positive impact funds. Our funds weight towards companies with the highest ESG scores, and typically it means that overweight these positive impact companies, but it's not a positive impact portfolio. As the market develops, we might see this as a space down the line where the likes of Schroders or Dimensional are able to look at specific positive impact funds, but we believe this is probably a long way down the line.
Mm-hmm. We've got that investment philosophy, that rules-based approach we have to follow it, and I suppose, as Rob was alluding to there, bringing together ESG and evidence-based philosophy, you've got to stick to your own rules. And when we're very conscious about valuation, profitability, for example. So we will bring in these sectors when they fit in with our investment beliefs, and that's key here. And as Rob says, it's as we see the evolution of the space, we may start to bring them in, but they've got to fit our investment rules. It is an evidence-based portfolio with ESG at its heart, and we're not going to have bolt-ons around the edges. It's that clear, defined set of rules. Fantastic.
Okay, Craig, Rob, thank you for your answers there. I think that just about brings us to time today. So I just want to say thank you to all the speakers. Craig and Rob have just been on screen. We've got Kip and Eamon joined us today. Thank you for attending. I hope it's helped demystify that evidence-based ESG conversation. It's going to help with those client conversations. You can follow us on LinkedIn. Please do. Reach out to us. We're here to help, and we'll give you all information on today's session. So I look forward to seeing you soon and joining us in our next Progeny webinar live event. Thank you.